Farmers and ranchers have been dealing with low commodity prices over the past few years, which has led to the steepest decline in cash farm income since the Great Depression. And though there are a host of factors that have contributed to this downturn, could the tide be turning for agriculture? Sterling Liddell is Vice President for Food and Agribusiness Research with Rabo AgriFinance in Omaha.
Take the Dow Jones Industrial. You usually runs at a ratio of about 0.8 to the value of a corn contract. In other words, take the value of a corn contract, multiply it by 0.8, and you get the Dow Jones Industrial average. Right now, that's the Dow Jones is running at about 1.2 to 1.4 times a value of corn. That means that there's a big imbalance. That's very high compared to history. There's a big imbalance of where that money has been flowing to bid these securities higher. That gap generally is not sustainable. At some point, those will come back together, either through stocks coming down or corn or the commodities market coming up, or a combination of both. But it has to rebalance generally. And the way it rebalances is by speculators looking at the commodities market and not wanting to take more risk on securities and seeing, well, is there an opportunity to make a little bit of profit in this corn market? We have fewer acres. It's cold. Planting, there may be some disruption. There may be an opportunity for making a profit. And then you start to see bidding from that securities market redirecting some funds towards the commodities market with balanced funds and hedge funds.
So now the focus really turns on what comes first, stock market correcting or a rally in the grain markets. With another Ag News update, I'm Tony St. James.